All right, we're going to go ahead and get started, and people might wonder. Did everybody get the handout that I passed? That I made that was passed out. Just by way of introduction, my name is Blake Winchell, and I teach the Search Fund class at IE Business School. I've been doing that for 4 years now, so just this morning, actually at 11:30, finished the last session of that class in Madrid. We were very lucky in that Kevin Tweel from Asurion was able to come to Madrid and teach the Asurion case before coming on to Barcelona, so that was a real treat for the students. I think several of my students jumped on the train with me and Kevin afterwards, and they're coming into the Barcelona conference. I actually did a search fund myself a long time ago, before I even knew what a search fund was, but I knew that I wanted to buy and run a company, and so I did that. I raised money, went out, bought a company, did 3 acquisitions, sold the company to a public company that I actually became CEO of, and so I've been on the journey that many of you are on. And then finally, as many people who have gone through the search fund journey, I'm investing in search funds as well, because I think it's an incredible asset class, both because of the returns, because it's a lot of fun working with young people who are really excited about the opportunity to become a CEO at a relatively early age and apply their energies to buying and building a company. Can I ask just for a show of hands, so I've got a sense of the audience, how many of you are currently raising a fund? Okay, so you're not closed. All right. How many of you have closed a fund? How many of you have done neither and are just here to watch? Oh, really? Those are my students that came in. Well, welcome. It was nice to see you this morning, and welcome to our session. What the organizers asked me to do is to try and talk about best practices for the first part of a search fund. And in looking around the room, we've got several experienced searchers who actually have done the round trip, raised the fund, bought a company, and sold the company. I would encourage you, Jason, and others who have got that kind of experience to pipe up. And also those of you who are actually beyond the first 200 days to pipe up with suggestions. And those of you who either are raising a fund or have closed a fund but are within the first 200 days, please ask as many questions as you want. You've got a lot of resources here, and you should take care of it. I think we've got a little over about an hour and a half to do this. I thought about the best way to kind of pull this material together, and one of the things that occurred to me was to just go to the materials that I use in class about the search process and about early due diligence and late due diligence and talking to sellers. But I decided that the best thing to do was to go to my portfolio of search funds and ask them 3 questions. What have you done that's really worked for you? What have you done that has not worked for you? And what have you not done, but that you wish that you'd done in your first 200 days? And there are 14 funds, and I won't go through all of them here. There's actually a 15th fund that's closed, Encino Capital from, Arista Capital, Encino as well, but Arista Capital here in Spain. And I'm really grateful that all 14 funds responded. It probably represents 22 different searchers. And they responded to those 3 questions. Of those 14 funds, there are 5 of them that are U.S. funds, and then 9 that are non-U.S. funds, representing 7 different countries. So there's a real variety of responses. I decided the best way to do this was for me to set up a couple of slides that were like straw men to raise various topics of different phases and to share with you a couple of things that the searchers that I've invested in told me, and then to ask those of you in the room who are well into your search to add to that, or if you've actually bought and sold a company to add to that, and then those of you who are raising funds to ask questions. And we'll do it after each section so that we can kind of move along and we don't push the questions until last and then run out of time. You should have gotten a handout when you came in. This is the comments that I got back from the 14 funds that I've invested in. And there's a couple of pages at the end for you to take notes if you'd like, or take notes on this. You'll notice in going through it, that not everybody kind of agrees on the best way to do the process, and that makes sense because there are a whole lot of ways to skin this cat in each of the stages. And so one of the things that you should do is really kind of find the process that feels best for you, that's right for you, and stick with that. But you'll also see that there's a great deal of consistency in the suggestions that were made by the various funds. So let's start with what happens, what some of the comments were about during the fundraising period. One of the Brazilian funds said, form your company as early as practicable. You don't want to form it before you know you're going to close, but very often there's 2-3 months between when you know you've got enough subscriptions so you can close and where you actually call the money and you start your search. They found that it took 3 months to get their legal entity set up. Depending on where you are in the United States, it's relatively straightforward, but in different international venues, it can get pretty complicated as to how you set your fund up, because you've often got to take into consideration the tax considerations of both U.S. investors and foreign investors. There are currency considerations and a lot of other things as well. There are sometimes common stock issues around how do you give common stock to the founders and not have it create a big taxable event for them. And every country is different. So once you know that you're going to close, or you're highly confident you're going to close, one searcher said, go ahead and get going, because if you wait until the money's in the bank and then you open your entity, you've got 3 months really before you've got the entity down, and you can spend that money, but you don't really necessarily have an entity that the investors can fund. Another one of the searchers said, ask early for soft commitments. Their comment was, you may, as you're talking to investors, it's really a dance, because many investors want to wait until they understand better what your syndicate looks like before they commit. And so it's always a question of who's going to commit first. And very often, this searcher said that they asked basically if people would like to reserve, an investor would like to reserve a unit, which isn't a hard commitment, but it's kind of an indication of interest in a soft commitment. I am one of those people that waits to see what the syndicate looks like, both because I like to see who the local investors are, and second, because to me it's really important to have one of the major institutional investors investing, not so much because they give credence to the deal, but because my primary business is venture capital investing in Silicon Valley. And so I'm always available to searchers, but I rarely go on boards. And so it's always helpful for me to have someone who's taken a couple of units and is going to be making a larger financial commitment to the fund and to the deal, to be the person that looks at the documents where they've got a lot of experience and sort of negotiates on behalf of the investors. So asking for soft commitments early is good. What I will typically say is, I'm very interested. Please get back to me as you start to get hard commitments, because I'm real interested in this, and that's sort of an indication of interest. Several people suggested that it's very valuable to demonstrate a thorough understanding of the search fund model so that it gives you credibility with your investors as you're talking to them. And they suggested a couple of ways to do that. One is to make sure you talk to as many other searchers as possible to really get their perspective. And that's something that you should do, and that'll come up as a recurring theme in the suggestions that we got. A number of people interned for search funds before raising their own search funds. I know Gerardo did that with Sachem Partners, and you actually see the process there, and you can pick up best practices in your own if you intern for a search fund. And then finally, if you're still in school or going online, there's a lot of videos, or if you're in school taking a search fund class, really helps you understand the model. So the better you understand the model, and particularly the more that you've internalized the criteria, and you really understand not only what they are so that you can list them, but why those criteria are important, the more credibility you'll have with your investors as they talk to you. Because one of the questions I ask when I'm talking to searchers is, what are the criteria you're looking for, and what are the two most important? If you had to have two and you weren't going to have anything else, what would those be? And then more importantly, why those two? And the quality of those answers becomes important in communicating how well the searchers understand the search fund model. It's useful to begin talking to companies while you're fundraising. And the searcher or the team that suggested that said it helps you create a sense of urgency when you're talking to investors because you've got deals on the line and that you can create a sense of urgency. I don't think that's actually the reason to do it, because no investor is going to invest because you're starting to talk to companies early. And frankly, no investor expects you to be talking to any company of any kind of quality in the first 2 or 3 months, much less the first 2 or 3 weeks. But it does kind of start to get you up to speed in what your story is. And when we talk in the next section, we'll talk about how you put that story together. But starting to talk to companies while you're raising your funds is a very good idea. A couple of searchers basically said, consider not renting office space, or if you're going to rent office space, minimize the space that you're going to rent. Nobody's going to see it but you, and if you're searching with a partner, but you and your partner, nobody's going to see it. And it just doesn't make a lot of sense to spend a whole lot of money on nice office space. Plus, if you're doing this the right way, you're going to be spending much more time on the road and out in talking to companies than you are in your office. So that is a way that you can kind of minimize your dollars, because the more you minimize your dollars, the farther they'll go. You've got to realize when you raise your search fund that you've started a ticking clock. And you're spending roughly $3,100 a week, or roughly $40,000 or 1 unit a quarter. And so every hour is for every searcher is about $65. And so the less money that you can spend on office space, the longer you can make that money last in case you run into a situation where at the end of your search you're finding something interesting. And I'll mention that again in a couple of points. Another searcher said, think really carefully about where your leverage is. There's a whole lot of things that you can spend your time on, but time is money in this business, and you want to think about how you spend that time. Do you spend it with interns? Do you spend it on IT and apps, basically, to automate your searching? Do you spend it on getting up a website? What activities early on, as you're beginning your fundraising, you're thinking about where you're going to spend this money in the first several weeks? Where's the leverage? And another searcher basically, and I'll get to that in a minute, but they said don't overdo it. Don't try and set up a small private equity fund, because that's not really that's really not what you are. If you have a choice, be selective with investors. You've got, if you're an international search fund, which is really what this conference is all about, you've got local and US, and you want to have both. And you've got individuals, and you've got institutions, and you want to have both. And you have people who are familiar with the search fund model and those who aren't. And usually you might want to have both. You may want to have somebody come in who's not familiar with the search fund model, but is a terrific operating executive that you know from your own network or for your home country. So if you're lucky enough to have the ability to sort of pick your investor group, put one together that really that kind of covers the bases, and make sure as you're talking to them that your goals are aligned. That you're really looking for the same thing. Everybody is looking to be successful, but there are some investors like myself who are really focused on the search fund model and don't want to invest in anything that doesn't, meet those criteria. There's others who are happy to be more opportunistic. So make sure you have those, you ask those questions. And one of the searchers said that they did at least two blind references on every investor to find out, what's this guy or what's this gal like to deal with? Do they just invest in search funds and then not come up with an equity check? Do they argue with you a lot about insignificant points in the in the agreement, in the investor agreement? Do they play well with others? Do they get along with other investors? Are they team players? What do they like when you buy a company? Do they make time for you, and do they advise you? So. If you have the ability to kind of put your investors together, one of the things you want to be careful about is if you've got a 15-unit deal and you've got 25 different investors who want in. This is not one of the comments that came from my search funds, but it could have been. Selling half units is a two-edged sword. Right? You get more people at the table, but there's a lot more people at the table that you've got to talk to in order to kind of herd the cats together. So the best thing to do is to sell 15 single units to a really diverse group of folks. But you might find yourself in a situation where you're going back and saying, would you mind taking just a half unit because I'd really like to bring this other person in? Or Nextline actually came to us and said, look, we've got a couple of German investors. We're actually going to expand the amount of money we're raising for our Polish fund because we've got a couple of German investors that we really want to bring in and we think that they would be helpful. And finally, one of the searchers said, negotiate everything. Negotiate your intern salary, negotiate the occupancy cost, negotiate the outsource deals that you do with whatever outsourcing groups you're going to use, because you may need the money. There are so many stories, and there are a lot of cases in that I teach where you've got 3 months of cash left, and you're finally in due diligence on a company that you are interested in buying. And in fact, Jason Pananos had to basically ask the seller to send him a check for $30,000 so they could do the due diligence to buy his company. And the amazing thing is they did it. The seller sent him a check for $30,000, which allowed them to buy a company that turned out to be a fantastic company. Not all sellers are going to do that. So if you have if you can keep your burn rate low, you might be able to turn 24 months of cash into 26, 28, 30, and that may be the difference between doing a deal and not doing a deal. So that's kind of during fundraising. Those are the suggestions that surfaced from my 14 search funds. A number of you are well into your search. Do you have anything to add to those? And please don't be shy. This is supposed to be highly interactive. That's what everybody wanted, the organizers and the attendees.
I think with office space, that for example, in our case, people actually look if we have the money in terms of credibility, and they look where our office is.
So they really do come to the office. Okay.
We have sellers coming to us.
Interesting. So I usually schedule those meetings someplace else. Can you meet at a hotel or something? So that may be true. That may happen, particularly if you're dealing in a smaller geography where the companies that you're talking to may be nearby, as opposed to you're running a search out of San Francisco and you're looking at everything west of the Rockies, where it's very unlikely that any of them are going to be in San Francisco. You got anything to add to that, Jason?
No,
No?
Do you see differences in spending between year 1 and year 2 searches?
Yeah, for sure. Year 1, it's really more about screening, and there's a lot of screening expenses. Year 2 is when your due diligence hits, and you're doing first stage. And I'll get to this in due diligence. You're doing first stage due diligence in year 1. You're doing some, and you may do one second stage due diligence. In year 2, you're much more likely to be doing second stage due diligence, which can get very expensive. So people tend to, when you see budgets and PPMs, it tends to be the same number for first year and second year. That's really, in reality, that's not what happens in the second year. You have much more diligence expense, because that's when all of the searching that you've done in the first year and you've narrowed those companies down, you're getting into that diligence in the second year. Any other questions?
Excuse me.
Yeah, please.
Do you think there is an ideal pipeline of screening?
We'll get to that.
10 companies?
We'll get to that. We'll get to that in the next section when we're talking about the search process itself. This is really more on kind of what do you do before you actually have the money in the bank is kind of this one. Yeah.
Anecdotally, you hear a lot of searchers negotiating their due diligence costs to be success-based. Based on your experience, how likely is it to get people to do that? Is it the standard?
So I want to make sure I understand your question. Where is that the due diligence costs are reimbursed by the seller if you don't do a deal, or is it?
Maybe the accountant, for example, does a quality of earning, but only charges you when you go through with the deal. I've heard that people were able to negotiate that.
That's an accountant who needs work. Generally, that's a lawyer that needs work. That's a due diligence firm that needs work. They may do that, and it may be more common internationally than it is in the United States, but I think it would be difficult. Now, if it's different if you've got a lawyer and you basically have come to agreed on all your terms, and they defer billing until after the deal closes. That does happen. But when you're doing a quality of earnings report, when you've got a third-party due diligence firm in there, you're still a pretty long way away from closing. And contingency-based agreements, I would think, would be unusual. Not unheard of, but I would think that they'd be unusual. Who else got a question?
It is very customary for, at least in Mexico, it's very customary to have contingent rates, tariffs, and when you do rates, and when you do is you close the deal, you pay a premium on the deal that you close, and all the other expenses get accrued but not paid. And the lawyers basically in with you if you don't close the deal, they lose their time and they owe the money. And it's usually lawyers that will demand to be lawyers once you do a transaction. So they're sort of investing into us well. And we did it with a very good law firm and also with KPMG in Mexico. We did it through a partner. We got them to agree to different rates. If it was like a broken deal, we would have a different rate than if we completed a deal. And that way
Yeah, I could definitely see that. And as I said, law firms, it happens all the time. It happens in venture capital deals all the time with law firms. And I could see it for sure negotiating different rates, but I don't really see it necessarily where a broken deal rate is zero.
with lawyers, yes. With the accountant.
The KPMG, yeah. Thank you. I had not had that experience. Who else? Questions? Suggestions? No? Okay. So the next kind of phase after you get your funds closed is how do you generate deals? And this gets to your question over there, and that's deal flow. And there are a number of pages in the handout on that, and a lot of great ideas. I'm going to summarize those, but and I'll also then sort of go off script a little bit and talk a little bit about some of the details. There is a consensus with all the search funds that I'm invested in, is that you really want to get your pitch down early. And you want to basically have a profile and a pitch that you're very comfortable talking about. Who you are, how you happen to be calling them, why you're an attractive buyer, and why you're interested in them. I've got to put on my glasses here, I can see my notes. One of the searchers said it is better. I mean, if you can pitch yourself as a previous entrepreneur with a family office money and not a PE firm or a search fund, that is going to be much more appealing to a seller. And I think I can see why that would be. It's really important that you don't lie, though. You need to be true, you need to be accurate, but you don't have to tell them everything. One of the things that I would discourage you from doing is trying to explain or educate a seller as to what a search fund is and the fact that your investors have to make a decision of whether they're going to put the money in on a deal-by-deal basis. Particularly early on, you want to go in and represent yourself as being someone who is well-funded and looking for a company with a certain amount of, with certain characteristics. And when you find that company, you're going to buy it. And you've got the capacity to buy it, because the truth is, if you tell them the characteristics of a great search fund company, and if you do find that company and you can negotiate pricing with the seller, you will buy it because your investors will invest in that company. If you can stay away from, we're a private equity firm, we are, it's a search fund, and because both of those can have negative connotations, and talk about your entrepreneurial interest. Because usually you're pitching an entrepreneur. The person who's the seller is an entrepreneur themselves, and it's been said so many times, they're looking for a younger version of themselves to buy the company. And if you can sort of pitch yourself as the younger version of themselves, so as they're looking at you, they kind of see themselves 30 years before, they're going to be much more interested in working with you. Someone also said if you've got, on either side of your family, if you've got family businesses, you can say, I was raised in a family business, and I've really wanted to run a small business all my life, and that's what I'm looking for, is to replicate that. The more you can sort of help them identify with you as an entrepreneur that kind of shares their vision and their goals, the more empathetic they're going to become to you. I talked to a couple of these guys and that I'm invested in just outside. We were talking about, because they relatively recently closed their funds, and they said, "Yeah, we had 9 meetings in the last 2 weeks." And I said, "Were these proprietarily sourced, or were they opportunistically sourced through brokers?" He says, "Oh, these are all broker deals," and I think that's great. Getting intermediaries early is a terrific way to get out and really accomplish 2 or 3 things. The first thing is you can get face-to-face with owners relatively quickly and hone that pitch that you've been working on, because you're talking to an owner. You've got to recognize that in many cases, most cases, you're not going to buy a company that a broker has given to you, because most of them don't meet the search fund company criteria, and the ones that do, you're going to be overbid by institutional investors, by the mid-market PE firms, because these companies are being widely marketed. But it does give you the opportunity to engage really early with sellers and develop that pitch and develop that confidence that you really know how to pitch yourself, and you'll hone it. You'll find that you're getting better and better doing it. If you've got a partner, one of the things that you want to do is you want to role play these pitches before you go out. Role play those with each other and have your partner ask you sort of questions that are going to throw you off, and figure out how you're going to answer that. Because it's one thing to kind of put in your own mind, here's my script, and it's another thing to actually be able to say it and to be able to react in real time and be convincing and be transparent and be authentic and be humble as you're presenting yourself. And so role playing, and if you don't have a partner, if you're a single searcher, go find a friend or somebody else and role play that as much as you can. And then try out that role playing on companies you're being introduced to through intermediaries, because you'll be able to get that pitch down. But recognize that it's unlikely that the deal that you find is going to come through an intermediary. One other thing I should mention, a lot of the searchers found that they knew that they weren't going to be interested in deals that were sourced through intermediaries, but one thing that they did use intermediaries for is to find industries that they thought were very interesting, because as part of the packages that you get on the companies that are for sale, you get a lot of detail on the industry and why the industry is attractive. So you may be looking at this one deal that's being pitched by a broker to you and say, wow, I really like this industry. On my industry focus searches, which we'll talk about in a second, I'm going to go out and do a deep dive in this industry, and I'm going to find 20 or 30 other companies and really kind of go through those on a proprietary basis and see if I can find a great deal that I can make for sale to me. So that's another valuable kind of benefit of talking to intermediaries. And the last thing I'd say on intermediaries is that I do believe that intermediaries play a different role in international searches very often than they do in U.S.-Canada searches. One of the searchers basically said in Mexico, the intermediary community is very important, and they basically, in their first few months, talked to 150 different intermediaries face-to-face, not over the phone, but face-to-face, because they really wanted those intermediaries to be out looking for them and trying to help them. Now, there's a flip side to that, which is searchers say, well, intermediaries really would prefer to work with private equity firms than with search funds for two reasons. Private equity firms have got blind pools, and search funds don't. Private equity firms are likely to give them repeat business, and their perspective is search funds don't. If you run into that, what I would say is, listen, one of our growth strategy is through acquisition. And so there is I'd like to develop a relationship with you, because even if we don't find something right now, we're going to be looking over the course of the next 5 to 7 years in acquiring other companies in the platform of whatever company we buy and growing it. And again, that gives them an incentive. To work for you. But recognize that the odds are that the best company you find is not going to be brought to you through an intermediary who's trying to auction it off and get the highest bid. But it's a company that you approach that may not be for sale in your first call or when they first get your letter, but actually, as Coley Andrews says, you make that company for sale to you because you happen to be in the right place at the right time. And that's kind of what you want your whole pitch to be around as you're reaching out to various companies in your search process, and that's really the proprietary search. Best practices say that blast emails really don't work that well, and you can actually make them work a little better through A/B testing and sort of the way that you phrase them, but best practices are that handwritten letters work the best. One of the searchers says they send them out in blue envelopes so that they stand out from the letters, from all the junk mail that they're getting. They're always hand addressed. You don't have to do all this yourself. You can actually outsource that either to interns or one of the searchers basically talked about using Upwork and a company in the Philippines to do some of this work. But these letters don't have to be written by you, but they do need to be personalized. So over time, what you need to do is you need to think about templates. How do you put together a template? And those templates will vary from industry to industry. And then you want to personalize it as much as possible based on what you learn about the seller by sort of digging into whatever data is there. It's also been sort of demonstrated as best practices that following up with this letter is with an aggressive email campaign is a really good way to figure out who may be a real seller and who may not be. One of the searchers said you're going to get some nasty emails back saying stop bothering me, but if you don't get a few of those back, you're not being aggressive enough in your email campaign. And so you want to follow that letter up with an email. By the way, one of the searchers said that they enclose a cookie in the blue envelope because it's harder to throw something away with a cookie in it. Coley tells a story about a Scottish searcher that put a piece of Scottish toffee in each of his letters, and you'd be surprised at how much that affects the response rate. So think about how you can differentiate this letter that you're sending out, and be creative. Don't just because Blake Winchell said put a cookie in it. Think about how you can differentiate yourself. Put $1 in it and say, there's 7 million more of these. If you call me back, I'm serious. Think about what you can do. I'm serious. What you're trying to do is you're trying to get them to open the letter, you're trying to get them to remember you, and you're trying to get them to email you back or tell their secretary, when Coley Andrews called, when Jason Pananos calls, I want you to put him through. That's your objective, because you want to get him on the phone and find out two things. Number one, is he a seller? And number two, is his company attractive? And if it is, you're going to get on a plane and you're going to go there, get in your car, and you're going to go there the next day, and we'll talk about that in a second. There's a lot of stuff that you can do on the web. A number of you are very sophisticated with HTML programming. One of the searchers basically said that they programmed they programmed LinkedIn to scrape the web for email addresses and physical addresses in the geography that they were searching in. And then they said, don't tell them because it's probably against their terms of service. But there's a lot of ways, and if you can program, or if you know somebody who can program, there's a lot of ways that you can scrape the web in order to get information, both about companies and specific personal information about the sellers. You want to use a CRM program, and you want to use an email automation program. There's a couple that have been. There are a couple that were suggested here. One of the searchers said that they used Yesware for their email automation program. Another one used Reply.io. One of the advantages of talking to searchers that are out there and have been doing this for a while is you can say, can you tell me what tools you're using? And the same thing is true with your CRM. You're going to need a CRM that allows you to help track all of the deals that you're following. I forget, there's a couple of suggestions in here about CRM programs that you can use. People sort of discourage the use of Salesforce, but there are others that are a little simpler that are perfectly adequate for the purpose of following your search fund companies. And finally, it's about the numbers. You want to track your response rates and hone the process so you can see what's working. That's really important. But another searcher cautions, you don't want to send out 100,000 emails and think that you're doing a good job because you've sent out a lot of numbers. It's really more about the quality of the phone calls that you have than anything else. If you're not getting quality phone calls out of your outreach program, then you want to test other outreach programs so that you maximize the number of quality phone calls you get, because getting them on the phone is step one in that process. And you got to get them on the phone, and then you can find out if they're a seller and if the company's attractive, and then you go meet them, and then you talk about price, and then you get an LOI, and then you go into due diligence, and then you go into documentation, and then after that you go into documentation. But it all starts with the phone call, and so that's really your objective. Do industry sprints. If there's two of you, each of you take a different industry, don't work on the same industry, and go deep into it. And maybe give yourself a week or max 2 weeks to basically go through an industry. You're looking for an industry that's growing, obviously, and so do industry sprints and meet and talk about what you're finding out as you do these industry sprints. And you may start out with 20 different industries, and you pick the two best ones that you think based on your criteria, and then just put the pedal to the metal for a week or 10 days or 2 weeks and talk to as many companies as you can and see if you can shake one loose in that industry. And if you can, then you start to pursue that. Get out of the office and Jason.
I would just say in the sprint, I think it's important to talk to owners early in your sprint. You will learn way more because you're not prepared in that industry. Learn from the owners on those calls. 2 calls with owners, you'll learn more than the whole week doing research.
Oh, when I say industry sprint, I'm not talking about doing research. I'm talking about calling owners in the industry. For sure. Now you might spend a day doing research to determine if it's an industry you're really interested in, and if that's the case, you spend the next 10 days calling owners and talking to them. Sorry, I didn't clarify that. The sprint is about calls and letters. It's really about letters and then calls, and it's not about just doing research. Which gets to my next point. If you're sitting at your desk all day long, you're not going to find a good company. You need to be out and calling on people and meeting with owners. And in the first few weeks, there won't be a lot of those, and those that do will come out of intermediary deals. But once you get to week 4, you really need to be out meeting with sellers, and because not only is that going to make you a more effective communicator, but that's the only way you're really going to figure out whether it's a great company and whether the seller is real.
It's actually a question on industry sprint. I want to give some perspective on best practices and how to keep developing a long list of industry to research. We have been doing this for a year, and sometimes I feel that I've seen everything, but obviously we didn't. So happy to hear some perspective on what people are doing to get to know about those hidden industries.
Yeah, I was going to actually say the same thing. One of the great opportunities is to look for other deals that have been done by searchers that either have good early returns or that have exited well, that you can actually focus on in your geography, because a lot of these companies are regionally focused. I just taught yesterday the Workwell case for the last the couple of days, and one of the things in the case is it's disguised, it's the PEO industry, and they say a successful deal had been done in Hawaii, which is one of the reasons why they felt like it was probably a good deal to a good industry to be focused on. So great suggestion. Any other suggestions? Yeah.
Question on what you're saying. The phone call with the owner will give you two things. One being if it's for sale, and the second if it's attractive. I mean, I'm just a little bit I'm wondering if you're talking to the seller or to the owner, he knows you're potentially a buyer. He will give you a pitch for his company. He will not tell you any risks, or he will treat you differently. For example, if you're his advisor on sales. So
Sure.
the real thing in how the company is really attractive, you can only learn to do it if he provides you with documents. So I'm just trying to see what you mean by you will find out how great it is.
So are you concerned that you won't find out if it's for sale or not, or are you just concerned about whether you find out it's a good company?
For sale, maybe.
Yeah.
But how will you know it's a company great? Like 80% probably.
So here's the way I would do it is first of all, you're not going to be talking to them unless you like the industry. Because if they're not in an industry you like, you wouldn't be contacting them in the first place. So what you would do is basically say, what we're looking for is we're looking for companies that are doing somewhere between $5 and $10 million in revenues and have got profit margins. I wouldn't use EBITDA. They've got profit margins of roughly 20% and have at least $1.5 million in free cash flow. And if he says, yeah, we've got all that, then you've got to kind of figure out whether you want to see him or not, and you might push on it a little bit. But if he says we've got all that, then it may be worth going out there. And if you get out there and he's doing $2 million and losing $400,000 a year, then he lied to you, and that's going to happen sometimes. But you'll get better and better in terms of asking the questions that'll surface that. But you got to really kind of give them your criteria and say, we're serious about buying a company. These are the parameters that we're using. Can you help me understand, whether you meet those criteria? And if they won't tell you, then you're talking to the wrong person.
The most important would be the projections.
But then you're not going to get on that phone. That comes from the meeting. Job number one is get them on the phone and figure out if they're real. Job number two is get in front of them, look them in the eye, and figure it out if they're real. Job number three is to get some data, and job number four is to sign an LOI. But that's kind of the series that it goes in. No.
I just want to back up the thing is super powerful, right? Because it gives you confidence that you already know that if this company is in the ballpark of the size range, you want to go see that person. So sometimes that tack of being very direct on the criteria is effective. Sometimes it can also put people off a little bit. So I think there's another way to approach it too, which is a little softer. Tell me about your employees. Tell me about the company story, right? And right there, they'll start talking because that's not threatening. And you will hear in that the growth trajectory of the business just based on talking about the growth of the employee base. And if you know that industry generally has revenue per employee of $200,000 or $300,000 per company, you can know in your head without asking him, I've got a $10 to $20 million revenue business up and over that front. That's super powerful. You don't need to know anything else to know. Now I want to go see that person in person. Very, very good. That's point number one. Point number two then is, are they motivated or not, right? And that generally is going to be a personal
Much better approach.
Two comments. I mean, in Portugal, a small country, and if you narrow your search only to in industry focus, you might end up nowhere because if you put the criteria, then you filter it down, and also, I mean, sometimes you find also because consider that the databases might have industry classification. A company can have several industry classifications, and then you don't really know if you're filtering down by the industry that is the main industry of that company. So in a small country, I say you should do industry search, but you should change once in a while. Do industry search, do regional search, then go to just one region and send to a lot of companies, because it's very easy to find only like 50 companies in the industry you thought it was very interesting, and then as you filter it down by the classification. The second comment is, so I got a deal that I thought it was never going to work out. I didn't close it at the end, but I thought it was, pure technology company for, it was education, and then I found out there was healthcare related, and so, but I didn't know, and I didn't know exactly what company I was going to visit until I talked to the owner. You get surprised a lot of times, and you don't know the business until you really talk to the owner. Second thing is, I always try to, every time I go to a meeting, of course we want to know the details of the company, but I try to avoid asking questions that sometimes the owner doesn't even know. Like, what's your EBITDA of, as for June? You can know that.
Yeah, you don't want to use MBA jargon. There's no question about it. You don't want to use it. I'm gonna have to move on here. Sorry. You're going to have particularly a small company like Portugal is going to have a completely different set of circumstances than if you're searching in Germany, for instance. And so it's just, the whole dynamic is going to be completely different. No question about it. Let me get through this and then we'll come back. I want to build on what Coley said though, because even if one of the advantages of having this really soft conversation is, even if they're losing money and they're small, you can learn more about the industry just by talking to them. And what you want to do is you don't want to be talking, you want to be listening, and you want to get them talking. So the more you can kind of ask them questions that gets them talking, worst case is you learn more about the industry. In best cases, you learn that this is a company that you might want to go see. But every single one of these, if you like the industry, and you shouldn't be calling them in the first place if you don't, every one of these conversations is going to make you smarter about the industry, which is going to help you on your next conversation because you know a little bit more. And you don't want to try and impress the person on the phone with how much you know about the industry. You want to be a sponge and kind of absorb as much as you can so that you do become an expert without trying to let them know you're an expert, because you'd like for them to educate you as much as possible. Let me just make two other quick comments. We haven't really gotten to talking to sellers yet. We got ahead of ourselves with one of the questions. This is really about generating deal flow and how you do your searches. We talked about networking with other searchers. There's a lot that you can find out by talking to other searchers. And industries that they think are interesting, particularly if they're non-competitive with you, other countries or other parts of the United States. Companies that they've seen that they're not interested in, but that are in interesting industries. If you've got a Rolodex of private equity contacts, talk to them about the industries that they think are interesting, because they're looking for some of the same criteria that you all are. And then the final thing that came up was interns. I'll let you read the comments that were made by our searchers because we're starting to run a little tight on time. But there is some differing opinion about how to use interns. Almost everybody agrees that it levers your time, but you've got to decide how you want to use them. And I would not have them on the phone talking to potential sellers. That's your job, because you're the one that needs to get smart about these industries. You may want to have them talk to brokers. You definitely want to leverage your time by having them do some of the scraping and the list formulation and culling work that you really supervise. So why don't we take a couple more minutes on this topic, and then we'll move to talking about these early seller conversations. There's a question here, yeah.
So, a lot of the things that you mentioned for generating proprietary deal flow are focused on what seems to be really sending out mass emails, contacting a lot of people, so that in that funnel you end up with a couple of people, a couple of owners
You're not sending out mass emails. That's been shown really not to work. You're sending out letters, and you're following those up with emails. But the letters are really key.
Okay, so my question is it really best to send out a lot of letters, emails, a lot of letters, or is it better to try to generate leads that are actually convertible through your network to really generate, so to say, proprietary deals, but that have come from within your network and you haven't had to, attack from the outside?
If something comes through your network, you shouldn't ignore it. Particularly if it's a company. In fact, Mike Smirklo, that's how he ended up buying Service Sources, that he found out about it through a friend of his mother. After doing this whole search process, he ended up buying a company that he found out about through one of his friend's moms. So you shouldn't ignore that. But the reality is, you've got to really talk to a lot of different companies before you find a great company that you want to invest in. So the key here is find a great company, and it may or may not come through your network, and you can't count on that. And if you do, you're probably going to run out of money before you find it. You really do need to do this larger outreach. Correct me if you think I'm wrong.
I agree, but I do think you can develop a new network. And that's the benefit, even in recognizing in the international is a little more challenging, of the industry-focused outreach. Getting on the phone with subject matter experts, maybe owners, maybe not, if you're going through one of these industry sprints, is developing a new network. And as you build that over time, that can be leverage for you out. And in fact, you have to pay those people if they bring you a referral to a company that you ultimately end up buying. That's a powerful way to create focused volume.
Yeah, I was just my experience from the five industries. I look at both analytics reports. They have very good country reports. It's breakdown according to each industry and forecast for the growth. So I got access for free to my website of my industry, and this would be one more resource to consider when you want to find these industries.
Yeah, well, I think, and one of the great things about interns that one of our searchers said is a lot of them are in school and they've got access to big, huge databases for free through their school, and that they can use that. And I don't know how that might violate any kind of school policies, but I wouldn't ask that question. Did anybody else have a question here?
Two things I'll mention here that you read about Trade Fest and River Guys. So I wonder
Yeah, Coley. That's actually what Coley was talking about was river guides. But go ahead.
probably paid for. So good question. So I think you pay, but you pay on contingency. I have not seen any retained type of search efforts be effective, frankly. I think it ends up being a big money loss. But happy to pay quite reasonably if it's a genuine referral that's outside of your spectrum of miles or contact that you're considering. And just to be really clear about that, if you find a good business, which is all we all want to do, and it's not through a broker channel, you are happy to pay hundreds of thousands of dollars for that. Because the opportunity cost of otherwise that business having been through a broker channel pays millions of dollars of additional price that you're likely to have to pay, but the reality is you're not going to buy the business. So I often see people over-indexing to tens of thousands of dollars for transaction fees or whatever referral fees, which if you're talking to the right type of people, is a rounding error for that. You're going to be talking to people who have been in the industry for a long time, so you're getting their attention, A, because they like you, and B, because you're going to pay them $200,000 if you happen to buy a business.
But you don't pay them for the referral. You pay them for a referral that you close on. Yeah, real quick because we need to move on here.
Just wanted to get a view whether there's any value in attending kind of industry conferences or trade fairs to actually generate deals. You from yourself or the other side.
I think it can go both ways. It's a great way to come up with names if you need to come up with names just walking around. It's also a great way to have conversations and learn about the industry. You're not going to necessarily generate deal flow by going in and talking to owners at these trade shows because usually that's not what they're there for. They're trying to find customers. But you can definitely, if you found an industry you really like, you can generate leads. Yeah.
I think those are more about network development and knowledge expansion.
Yeah, and then again, you can develop lists that you can follow up with later. Okay, so we've already talked about a little bit of this, but once you basically begin your search and you're doing an industry sprint and you're starting to talk to sellers, what do you do? How do you talk to those sellers? And more importantly, how do you have productive meetings with them? Everyone, and I completely agree with this, says get engaged in a process early. If you find a company that's really pretty interesting, and you meet them, give them, tell them that you'd like to do a little bit of preliminary due diligence because you're thinking about giving them a letter of intent. And you may do that, but one of the things you've got to be very careful about is this funnel that looks like this in terms of companies, looks like this in terms of time, right? So you can spend an hour essentially with a phone call between the setup and the call itself and getting off the phone with a potential seller. You go to visit them, that could be 5 hours, it could be a day, it could be 2 days if you're getting on an airplane. You get into early due diligence, that could be 2 or 3 days. You get into an LOI, that could be a week. You get into late due diligence, that could be 3 weeks to a month. And I told you how expensive this is. So realize that you want to be very efficient because the farther you get into that funnel, the more expensive in terms of time each of those steps is. Having said that, conventional wisdom, and I think this was echoed by searchers, that it's great to engage in a process early. As one of my searchers said in talking about this, they said, get involved with a process early, you'll learn a ton and get all the knucklehead things out of the way early. Because you're going to do knucklehead things early in the process. So you might as well get them done relatively early with a company you're interested in and an industry you might be very interested in, but kind of learn how that process works because you'll be much better at it the second time through. Very quickly, you want to identify non-financial reasons for selling. Coley brought this up. They could be health, they could be age, they could be a divorce, either a marital divorce or a business divorce. It could be a variety of things, but they're generally life events that happened relatively, that basically are happening to them right about then that causes them to be thinking about selling where they maybe weren't thinking about selling before. So you want to figure out non-financial reasons for selling. If they're thinking about selling because they think they can make a bunch of money and they're 45 or so, then that's probably not something you should spend a lot of time on because either there's going to be problems with the company or you're not going to be able to get to a price agreement. You want to get to price discovery quick because there's very often not very often, but it's not unusual for owners to want to get a free appraisal of their company. And they see a smart MBA calling them saying they're interested in buying a company. They say, come on out and meet with me because they're interested in figuring out what you think their company's worth. They might sell it at the right price. You probably aren't going to give them a price that they're going to sell it at. Now, what the advice that I give to my students, and I'd be very interested in what you have to say about this, is that early on that you want to be talking about cash flow multiples. Don't use EBITDA as a phrase. At least I would suggest that you not do that. You talk about cash flow multiples, and just give them a range of kind of what you'd be willing to pay in a cash flow multiple. And it might be a wide range. The narrower you can make it based on how attractive the industry is, the more traction you're going to get. Because they've got in their own mind what their cash flow is. And you don't want to start to argue with them now or get into all the details about add backs and what their cash flow really is from your perspective. So I think that it's valuable to break that up into two pieces. And as you're getting to price discovery, say yes, basically we think in this industry that that a really good company is worth somewhere around 5 to 6 times cash flow. And then let them think about that. And then as you get into due diligence, then you get into the tougher conversation of what is cash flow. Because Very often, if you give someone an enterprise value early on, and then you start to look at their numbers and their numbers go down or their performance starts to slide a little bit because for a variety of reasons, and you renegotiate the price down, even for a good company, it falls out of bed because they get an enterprise value number in their head. So I think if you can do it, splitting that into two pieces is valuable just to make sure you're on the same page. Coley, what do you think about that?
I would say, one thing I would add is try to read the type of seller you're talking to. There's a seller that will answer that question on sort of multiple cash flows. Then there's sellers that just have a fixed number that they want to clear. And that can be a really interesting situation. So, you know, if you thought about how much money you want to take off the table here, or how much you think the business is worth, you might get $100 million answer and it's worth 10, but at least you know that the party's over. But you also oftentimes will get, you know, whatever it is, 15 or 20 million, which turns out to be 4 times cash flow. And in fact, you'd be willing to pay 6 times cash flow.
If you can get the seller to commit to a number that they'd be willing to sell to you for, that's true. Savvy sellers are not going to give you a number. Savvy sellers are going to basically say, you called me, you're interested in this company, I want you to tell me what you think it's worth. And that's where you may just want to think a little bit about and use ranges as opposed to giving them a number and then going back and renegotiating that number, because you'll always renegotiate it and it will always go down, and very often you can lose a deal you might be interested in. But Coley, you're right. If you can get them to give you a number, do that. That's definitely the way to start. You want to focus on building rapport and empathy. Again, you want them to see you as an earlier version of them. You got to stick to your criteria. Don't fall in love with a company that doesn't meet, the top 4 criteria that you've got. Because even if you fall in love with it, odds are you might have a difficult time getting it funded by your investors because they're going to be focused on the criteria. And you don't want to spend a whole bunch of time on something that your investors aren't going to step up to just because you've fallen in love with. I'll come back to you in a minute. You want to get face-to-face with people, but you also want to be selective with those. And that's where your phone script comes in very handy, because you need to kind of figure out on the phone whether this is somebody you want to get on a plane or spend a day to go see, because that day has got opportunity cost based on other phone calls you could be having with potential sellers. So you want to be selective in face-to-face meetings, but nothing beats those. Phone calls are great, but you can learn so much in a face-to-face meeting. And finally, you all, I'm assuming most everybody here has an MBA. It's probably from a good school. You may have worked for BCG or Morgan Stanley before you raised a search fund. They don't care about that. And what you got to realize is, as smart as you are and as great as the companies you might have worked for, they have built something that's got millions and millions of dollars worth of value, and you haven't done that. And so be humble. If you're humble, you're likely to build that rapport much better than if you've got a little bit of your MBA hat on. That can be very off-putting to sellers. So just think about being authentic, being transparent, and being humble. It was one of the reasons that Jason and Jay were able to close Nashton, is because they developed a terrific rapport with the seller, and he got on the ledge a couple of times, and they had to talk him off of the ledge. But at the end of the day, they were able to get him to do the deal. All right, we had a question over here.
Regarding, I'm searching currently, and I had a situation where I discussed with the seller a price. He's like, okay, I like this price. I'm thinking about now taking it to a competitive, situation, right? And so, have you guys faced any of these situations where you're having a first conversation with them, it seems going well, and then they're just trying to maximize price by introducing 2 or 3 new bidders? And how have you handled that?
I've got an answer. Does anybody else run into that situation? How did you handle it? You might be able to get an exclusivity. If you do, great. If you don't, my response to that would be, great, do that. I'm interested in moving forward. I'm probably not going to be here by the time you run a process. I'm probably going to be gone. So I don't have enough time to deal with someone who's going to take my bid and shop it and run a process. So I'll be talking to other people, and I probably won't even be there. So then his stalking horse kind of goes away, and you can kind of figure out whether he's bluffing or not. Other questions? We got time for a couple more. Yep.
So in terms of building rapport and sort of the reasons for selling, so owners like selling commitment, I feel like a lot of business owners talk about this whole succession topic. A lot of them, I mean, the ideal scenario, a smart business owner prepares succession early on and thinks about it early on when the value of the company is probably at its highest. So, however, at that point, he doesn't have to sell. He probably is in a very strong position, and that would probably be his best position to sell the business.
So you use probably there 5 times. And that's really not my experience. These guys are running their own business, and if the only reason they're interested in talking to you is because their kids aren't interested in running the business, or they for whatever reason really need the cash. They're not building succession plans if it's not their family, and if they're looking to get cash in other ways, they're going to list it with a broker, and you're not going to buy it. Yeah.
Related to this, so we are talking about owners who are interested in selling or have some inclination to sell in the immediate future. But when I look at the statistics in the UK where I search, nearly 2/3 of the owners have no view of selling the business. So are we leaving that market out?
And before they open your blue envelope with a cookie in it, they may not be thinking about selling either. But what you're trying to find is the guy who opens or the gal that opens that blue envelope with a cookie in it, and they just had a conversation with their wife the night before, and she's saying, I'd really like to buy a house that's closer to our grandkids in North Carolina, and they're in Reno, running some company. And he's thinking about that conversation, and here's somebody who's interested in buying, and the timing just kind of comes together for you. So you're trying to make that company available for sale for you because of a proactive action that you take that makes them think about selling, and you're the one that did it. And so you're the only buyer at the table when they do that. That's the whole philosophy behind the proprietary search process. They probably aren't for sale.
That's what I mean. I mean, at that point, the commitment to sell is probably not necessarily very high, but you create that.
That's exactly that's the job. That's your job. And you want them to you want them to fall in love with you, which is why they want to sell to you. Okay, so I've got a couple more things, and then we're going to open it up more generally for the last 10 minutes or so. A couple of folks, many of my searchers have not gotten to closing a company. Basically, 3 of them have closed, and the other ones are still searching, but everybody's done a letter of intent. And the 2 pieces of advice that came out of and again, I asked them about the first 200 days, and you'll probably enter into 1 or 2 LOIs in your first 200 days, maybe a few more. But a lot of that first 200 days is going to be spent getting your pipeline together and doing the conversations that go up to an LOI. Someone said include as many terms as possible, not kind of nitpicking terms, but the important terms, include as many as possible, so that you kind of figure out where the hot points of the sellers might be. It may be that in your LOI that you ask for $1 million seller's note. Or that you might ask for some degree of seller financing, and they come back and say, we're really not interested in doing seller financing. You might ask for exclusivity in your LOI, and they might say, no, we're not interested in exclusivity. Or they might not say anything about it at all, in which case it's great. So you want to include as many terms as possible. And for your first LOI, you definitely want to have a lawyer work with it. You don't take somebody else's template and just modify it for whatever this deal is. Get together with a lawyer, because you'll have had a lawyer already because they put together your search documents, and make sure you really kind of understand the process. As you get into more and more LOIs, you will develop a template that is it's exclusively yours. But for the first one, make sure that you have a lawyer. And then a couple of searchers said, you really have to tie, if you are giving them an enterprise value, you have to tie it to an EBITDA multiple, because they ran into a situation where performance deteriorated. And so what they were willing to pay went down, but from the seller's perspective, they got this number stuck in their head, and that number wasn't going to change because that's what they thought the company was worth. And it's hard to sort of to walk them back to the fact that you're doing an EBITDA multiple, which is why I was saying if you can't get them to commit to you to what they would be willing to sell for in the LOI up front after the preliminary due diligence, just put the multiple. If they come back and say, well, what does that mean? You say, well, we need to sit down and I need to go through your detailed financials and do due diligence, and then we can agree upon what cash flow is. But this is what we'll pay as a multiple of what we agree on. Okay, any questions about the LOI? It's good to do one of these early because you'll learn a lot in going through this with a potential seller. Due diligence, as I mentioned, generally, I mean, you're in due diligence on a deal, on a consistent basis, but it really falls into two buckets: early due diligence, which is before the LOI, I'll come back, and late due diligence. Early due diligence is not expensive. Late due diligence can get very expensive if you're getting quality of earnings reports and you're getting outside due diligence providers that are basically charging you an amount to do due diligence. So you want to try and kill deals quickly. If you find something that's a deal breaker for you, meaning that it takes you off the 4 criteria or 5 criteria, then kill it. Don't try and find other things that might be mitigating if it's, if they have no recurring revenue. They have no recurring revenue. Don't do the deal. Or repeating revenue. The company is not making €1.5 million euros a year. It's losing 750,000 euros a year. Kill the deal. You just move on because you don't have time to try and see if there's something else in there that's really good. One of our searchers said, ask for more seller financing than you need, and ask for more bank financing than you need. And when you go back to the seller to negotiate the fine points of the agreement, as they start to ask you to take out things that they want or that they don't want, or put in things that they do, offer to reduce the amount of seller financing because you don't need it, because you've gotten commitments for more bank financing that you need. So that's a give back that's pretty easy if you've got it covered. Plus, generally in this interest rate environment, seller notes are more expensive than the bank notes. So you're replacing more expensive debt with less expensive debt. And basically, if you don't ask, you're not going to get. So don't be shy. Be nice. Be humble, but ask for what you want, and don't back off of it if it's absolutely critical to you. If you absolutely need it, whether it's a warranty and rep that you need about accounts receivable, or whether it's if it's seller financing or seller rollover, you need to ask for it. And if you don't ask for it, you're not going to get it. Yeah. It's totally not enforceable. I mean, you can put anything in an LOI you want, but I can promise you that it would be unusual for them to actually give you the money unless you're Jason Pananos and you can convince them to pay for their own due diligence. But that money was sent up front, right? Having essentially a breakup fee that goes to you from the seller is what you're talking about, I think would be very unusual, and I can't imagine a seller agreeing to that. Any other comments or questions?
Negotiation I had in the deal, we were having a fight about using the lockbox mechanism for the closing accounts, and then some investors said use the lockbox, but then the owner wanted closing accounts, and it's really difficult to explain in detail what this is about. Even like the accountant from the owner made a big confusion. This was in the LOI. It was really tough to get to this
That's a level of detail that probably confuses the conversation in an LOI. You're right.
We should leave it to the SBA.
Yeah, yeah, that's pretty detailed. I'm gonna need to move on. Hopefully we'll have a little bit more time at the end for any additional questions. Because one of the things that Rob wanted me to talk about briefly and to bring comments on was investor communication. It's really important. Investors aren't expecting you to come up with a fantastic deal in your first 6 months. At least the serial investors in search funds, we know that it takes a while to get the machine running. And so you don't need to feel like you've got to go back to investors or apologize at all. It's great if you found a couple of things that you're interested in, but we don't expect that. I'm a strong investor or believer in sending out sort of a day one letter, which basically thanks everybody for investing and saying, here's what we're going to be spending the next couple of months on, and that you'll be following up on a very regular basis for the first 6 months, and then you'll move to probably quarterly communications unless there's a specific deal that you want to talk about. And in that first 6 months, go ahead and communicate a little bit more regularly. Investors are getting to know you. I've invested in a number of funds where I hadn't met face to face. Like these guys, it was Skype. And so the tone of your communication, the professionalism of your communication is a way for investors that don't know you to get to know you and become more comfortable with you. Because if you're going to ask them to write a $300,000 or $500,000 or $1 million check when you find the company, you really want them to feel like they've gotten to know you. And that's in many ways what this 2-year period is for while you're searching. So don't be shy early on about over communicating. If they don't want to read it, they'll just delete it. If they do, they'll read it and they'll be grateful. But as you get into your search, more into your search, you can move to quarterly communications unless there's a deal that comes up, in which case you send out a one-pager. And that's the second thing, is if you've got an interesting deal, socialize that with your larger investors or your institutional investors, basically your lead investors. If they hate it, you want to know why. Because they've been doing this a lot longer than you have, and maybe they're seeing something that you don't see. If they hate it and can't convince you why they hate it, you need to really understand that they may not participate in the equity funding, which could leave you with a pretty big equity gap. And also your local investors may say, well, why isn't Pacific Lake investing in this deal? And you've got to come up with an answer to that question. So you want to get those investors involved early. Send out a one-pager, not to all 20 or whatever, but to 5 or 6 who you know will help you. They'll read it. They'll give you good feedback. And if the feedback's universally negative, don't try and convince them it's a good deal. Move on to the next one. Because if it's universally negative, it's not worth trying to convince them that it's a good deal. Having said that, once you find a deal you want to do, not all your investors are going to like it and are going to want to invest. If you've got 20 investors, there may be 5 that don't invest for whatever reason. I'm involved in a fund that I decided not to invest in the ultimate deal. Coley was very excited about it. I happen to have experience in that industry, and I still am having nightmares about my experience. But that was unique to my experience. We really like the searcher. I'm happy to help, and I wish him the best of luck. But it's just not an industry that I wanted to invest in. Similarly, there's another deal that came up. We're both in it, and I basically wrote a much bigger check than I usually write, and Coley didn't invest because it didn't really fit the traditional search fund, a lot of the search fund criteria, and that's okay. So not all of your investors are going to invest in every deal, but you want to make sure that you've got enough consensus from your larger investors that they're going to do it. And as I said, finally, be more frequent in your investor communication at first, and then move to quarterly. So let me summarize kind of what we went through here really quickly. You basically, when you're fundraising, you want to strive to get the very best investors and fit rather than quick close. If you have the ability to close quickly because you've got a bunch of local investors and maybe one institution that have committed, but there's others that have said, get back to me when you're kind of thinking about closing, circle back to those and put together the very best syndicate you can. It is going to really help you down the road. Hone your pitch. Role play with each other. Figure out how you can be the most compelling, the most empathetic, so that sellers really want to sell their company to you. And you want to stress that humility and empathy, not how smart you are or the knowledge you've developed about the industry or how much money your investors have got. Get early practice on broker deals. That's really good, but your proprietary search is going to yield the best results, so that's really where you want to focus your time. Develop a communications machine and stick with it and improve it. This is basically a process of constant improvement. And so the way you know how you're improving it is you measure your results, and you see those results getting better and better. And the results are phone calls, face-to-face meetings. Those are the results you're really looking for. Because once you get to the face-to-face meeting, then all kinds of other stuff comes into play. But what you're really trying to do is get that investor on the phone so you can either learn about the industry or so that you can pitch them on your deal. Use tools and outsourcing to automate that process, and that frees up your time. That automation frees up your time to focus on talking to sellers and meeting with sellers, which is what you want to do. Stick to your criteria. You've heard it over and over and over again. And one of the things that kind of I ask is of the criteria, what do you think the most important is? And it's a growing industry. So make sure you're sticking to your criteria. Growing industry with recurring revenues, a history of earnings growth, high margins, and at least $1.5 million in EBITDA. And does it have to have all 5 of those? No. Does it have to have 4? Probably. And if it doesn't have one, you've got to really understand why. But those are the criteria. Stick to it. And when you find a company that you're interested in, but it only has 2 of those, move on. Getting into an LOI early is really good because it helps you understand how to negotiate that. And you're going to probably end up in 3 or 4 LOIs before you get one closed. Do price discovery early because you don't want to spend a whole bunch of time on a deal where you're doing free appraisal for a guy who's not really interested in selling or whose price is so high that you're never going to get there. There's basically 2 phases of diligence. When you get through that first phase and you go into the LOI, kill mercilessly. When you find stuff that doesn't work, kill it and move on. You've got a finite amount of time and you're burning cash. Get your investors, particularly your lead investors, involved early and update them regularly so they get to know you and you get to know them and you can get a feel for the kind of deals that they're really interested in. And this is really important. Have fun, right? The search phase is not nearly as fun as the operating phase, but there's a lot of ups and downs, but there are going to be a lot of successes. So celebrate those successes because there's going to be a lot of downs as well. And so you want to have fun. It's one of the main reasons why you search with somebody else is because you can support yourself through that process. So that's a real quick walk through the first couple of 100 days. I didn't spend a huge amount of time on diligence and documentation and stuff because generally you're not getting into that deeply in your first 200 days. But if you kind of implement these best practices, I think you'll get off to a good start. Having said that, we've got 4 or 5 minutes left. If anybody's got comments or questions, particularly if you haven't said anything yet, I'd really like to have you do that. Are we done? Oh, I thought we were done. I thought they were leaving at 6:30. Okay, well, thanks for joining us. And thank you all for participating. Thanks very much.